The way the tax code is made, it's designed to incentivize people that are producing jobs, producing homes, and producing things for the economy. But if you're just a W-2 employee and all you do is you make money and you spend it, it is going to be extremely difficult, actually impossible for you to take advantage of the system because the tax code is not incentivizing you to really do anything. The tax code incentivizes you to invest and create and produce. It's not incentivizing you to just consume and spend and work. Now, that doesn't mean that you can't take advantage of anything that I'm going to talk about if you're an employee. That just means you're going to have to think a little bit bigger and do some things with your money outside of your job. That way you can take advantage of the system. And what you'll start to realize is if you don't understand the system, then you don't get any of the benefits. Like one of the biggest benefits that people talk about when it comes to home ownership and tax breaks is if you own a home and you have a mortgage, you get a mortgage interest rate deduction, which is great for your taxes and you get to take advantage of the system. But that's one big lie. Rich people and wealthy people don't care about the deduction because it's pennies compared to some of the other breaks that you can get if you understand how the system works. So let me start by talking here on the business side of things. The first thing that you have to understand is that you are taxed on your income. If you make a salary, if you make an income from your job or your business, you are going to be taxed on the income. If you work a job and you make $100,000, you're taxed on the $100,000. If you own a business and you pay yourself a $100,000 salary, you're going to be taxed on the $100,000 salary. But one of the things that you can do is not get paid through your business. So if you don't want to pay any taxes, then you don't want to have any income. Now, at first glance, you're going to say, if I have no income, then I have no money to eat. But that's not exactly correct. What some rich people are able to do is instead of taking out an income is they borrow against the value of their business. So let's assume that you build a business and it's worth $1 million. Well, instead of you taking out a salary of $100,000, you can go and take a loan against the value of your business for $100,000. Now, you still have $100,000 in your pocket, but this debt isn't taxable because you don't actually pay yourself anything. You're borrowing money from the bank, and now you have $100,000 in your pocket just like before, but this is tax-free because this is debt. Now, the thing that you have to remember is this $100,000 that you borrowed from the bank isn't your money. It's money that you're gonna have to give back to the bank plus interest. So if you have to pay this money back to the bank at, let's say, 6% interest, what you need to do is you gotta make sure that your business is growing by at least, what? At least 6% a year. Because if your business is growing by 6% or more a year, if your business is growing by 7% a year, then you came out a winner. So you didn't take an income. You don't have to pay any taxes on the $100,000. You borrow this money from the bank tax-free. And if you can grow the business by more than 6%, well, now you're a winner and you didn't have to pay any taxes. Elon Musk is probably the most popular example of this in action because he built Tesla. But while he was building Tesla for a number of years, he never paid himself a salary. So a lot of people were upset because he was worth billions and billions of dollars, but he paid $0 in taxes. The reason why he paid $0 in taxes was because he was paid not in dollars, but in stock options. So he never really got any money in the bank from his company. What he did was he got these stock options saying that he had the ability to buy Tesla shares for about $6 a share. It was something like $6 and some change, and he was given millions of shares. So when the stock price went up to $1,000 a share from $6 a share, he saw a lot of appreciation in the value of his stock options. And considering that he had millions and millions of stock options, he had stock options worth billions of dollars. Now again, this wasn't cash that he had in his personal checking account. This was the value of his investment, of his asset, his stock in Tesla. But instead of actually selling his stock and having this cash come into his bank account from the sale, that would be taxable. What he did was he went to the bank and he told them, hey, I have the stock worth $1 million. Just for example, give me a loan for $100,000. The banks were happy to do that because then the banks would make 6% interest, and now all Elon Musk has to do is make sure that his stock is growing faster than the interest that he's paying, because as long as he keeps doing that, he's coming out on top. He has cash in his pocket to live his life, and he doesn't have to pay a penny in taxes. Larry Ellison, the founder of Oracle, did the exact same thing. He had access to 250 million shares of Oracle, but if he sold those shares, he'd have a big taxable event. So instead of selling his shares and paying a whole bunch of money in taxes, he used the value of his shares to go to the bank and open up a $9.7 billion credit line. And now this is money that he can use to live his life. He's got to pay interest to the bank, but as long as the value of his company, his stock, is growing faster than the interest rate that he's paying, he's a winner. And then after that, they follow what I was talking about in the beginning of this video, which is BBD. buy, borrow, die. What that means is you can keep doing this again and again and again, and as long as the value of your underlying asset, in this case the stock, the company, keeps growing, you can just do this until you die. Now you get to live your life, you get to have all of the nice things, and you never have to pay a penny in taxes, and then when you die, you pass your shares on to somebody else, and the person who gets your shares, your new company, they get something called stepped up basis, and they don't have to worry about the major tax implications because of the stepped up basis. What that means is, let's assume that you have a company worth $1 million, but your basis, what you bought it for, is $1,000. So in Elon Musk's case, remember, he was getting shares for $6 a share, and then when the Tesla company went up to $1,000 a share, if he sold his stock at $1,000, he would have to pay taxes on his profit, which is the difference between $1,000 and $6, which is $994 per share. So that's a lot of taxable income. So assuming here that you had a basis of $1,000 and now it went up to $1 million, you have almost $1 million in taxable income. So if you were to sell, you'd have a big tax bill. So one of the things that you can do is the buy, borrow, die. And now if you die, your heirs, let's assume it's your kids, get this $1 million asset. And then when they get this $1 million asset, they get stepped up basis. So the IRS assumes that they don't get it for $1,000. The IRS assumes that they bought it for $1 million. And so if your kids now sell this asset for $1 million, they have $0 in taxable income. If they sell it for $1.1 million, then their taxable income is $100,000. So you only have to pay taxes then on any gains above the $1 million, which is what the kids got. Now at this point, if you're thinking, Jaspreet, that's really cool if you are a billionaire like Elon Musk or Larry Ellison, but I don't have a $1 billion or a multi-million dollar business, so I can't take advantage of this. Well, there's some other things that you can do. If you have your own business or you're a side hustler, so now you're not a W-2 employee, you are a contractor, you have your own small business, well, what you have to remember is you only pay taxes on what's left. So you have your income that comes in, and then you pay your expenses, which are your deductions, and this is your taxable income. So what you have to understand is what can fall here into your taxable income. Because a lot of times people ask, is this thing deductible? Is it deductible for me to go on a particular trip? Is it deductible for me to buy a certain item? Well, a better question to ask is, how can it become deductible? Because almost anything can be a tax deduction if you know how to ask the right questions. This is where it pays, literally, to have a good accountant who's a tax advisor who can tell you what's going on and how you can use your money, that way you have less taxable income legally while you can still buy all the things that you want. So, for example, one of the things that's going on until the end of 2022 is the tax code is giving bigger tax breaks for business owners that are eating out at restaurants. So if you go out and you take your employees out to eat, you get a 100% tax break until the end of 2022 as a way to incentivize people going out to eat at restaurants, as a way to help stimulate the economy. So if you have people on your team, or if you are a side hustler, if you're a business owner, you have the opportunity now to get a tax break for eating out at a restaurant. We here at the Minority Mindset Companies went to a hybrid style work office after the pandemic hit, which means that people come in the office when they want. You can work from home whenever you want. But once a week, we do something called Team Day, where the team comes into the office, and every week in this Team Day, we go out to eat at a restaurant. Now, we didn't start doing this because of the tax break that we were going to get. We did this for fun, but it's kind of a nice bonus that 100% of the money that we're spending at the restaurant is a tax break on my taxes. Let me give you another example. If you're watching this video when it goes live, I will be on a 2-month business trip travel where I'll be staying in San Diego with my business partner, working on a whole bunch of different things. I'll be meeting with a bunch of different business owners out there, doing some interviews, meeting some influencers. So doing work out of San Diego, I'll be living in an Airbnb with my business partner. And I should also mention that my business partner is my wife. This is a tax deduction and it reduces my taxable income. Now, you might not be able to reduce 100% of every dollar that you spend, but if you have a good tax advisor, if you have a good tax accountant, they'll be able to help guide you and show you how you can spend money and have that money be a tax deduction. Now, the money has to be spent in a way that benefits your business, but if you are a true entrepreneur, a business owner, a side hustler, guess what? Your life a lot of times is your business. And so you have to understand how you can use this system to your advantage. That way you can legally pay less money in taxes. Because remember, the IRS is just a rule book. You want to make sure you understand how the rulebook works, that way you can use it to your advantage. Thank you for watching. If you enjoyed this shorter clip from my longer videos, here's another clip that I think you'll love. And if you're interested in learning more about how to invest your money in the stock market, our team put together an amazing guide that will walk you through how to invest your money in the stock market, what the stock market is, different stock market strategies, and how to build wealth in the stock market. This guide is completely free when you sign up for our daily newsletter. So if you want to read this guide, all you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.